mortgage markets, and more. I'm your host, Peter D'Angelo. Welcome to Monday, everyone. I hope you had a wonderful weekend. We've got your mortgage rate update, and then we're going to talk a little bit about the Fed meeting last week, Jerome Powell's commentary, as well as his answering of some questions from reporters. But let's go over the numbers for where the interest rates stand at the end of last week. 30-year fixed-rate conventional mortgages were averaging at 7.03%. The 30-year FHA fixed-rate mortgage was sitting at 6.53%. The 30-year jumbo was averaging 7.38%. The 15-year fixed was averaging 6.57%. And the 7/6 SOFR secured overnight funding rate, that's the index for this adjustable rate mortgage, which is most common right now, was sitting at 6.72%. Kind of living in the same margin. Not much happened, and historically, not much does happen immediately following the Fed's press conference after their Federal Open Market Committee meeting. We'll also take a look right now at the 10-year Treasury bond. As we've talked about on past episodes, mortgage rates highly correlated to the 10-year Treasury bond, which is when you buy a Treasury, that you're buying the debt of the U.S. government, you have a fixed rate of return on that within that time horizon, and that means 10 years in this case. We're looking at that, and that was at 4.257% last week. And there's some resistance at the 4.2 level. For us to start seeing some improvement on the mortgage rates, we're going to need to see that 10-year bond come down in the yield to below 4.2 before there's, a meaningful impact to where the 30-year fixed rate mortgage is. It is trending slightly downward, with Thursday having a little bit of a tick up. We're going to see how this shakes out as the market and as everyone digests what the Fed announcement was sounding like on Wednesday last week. So without further ado, let's get into that. The Federal Open Market Committee met on Tuesday and Wednesday, capping off at the end with Federal Chairman Jerome Powell coming out and talking about their decision, which was to hold interest rates pretty much dead on everyone's expectation, which is right now sitting between 5.25% and 5.5%. As mentioned, it is a margin that the Federal Reserve sets for their federal fund rate, otherwise known as the discount rate. This affects all types of lending, not just mortgages, but any type of financing that you're looking to secure is affected by the Federal Reserve's Fed fund rate. They are keeping things there, but the most important piece of information, in my opinion, that we received on Wednesday was the dot plot. We talked about the dot plot back in December after the Federal Reserve had their last open market committee then, capping off the year of 2023. And that's when all of the committee members sit down and they write down on a piece of paper, they dot out where they think the Fed fund rate is going to go for the year ahead, and that gives you some insight into the outlook. They shared, Chairman Jerome Powell did share that they are still expecting, everyone had a consensus, that there will be 3 rate cuts here in 2024. However, it started to soften the outlook for further rate cuts into 2025 and 2026. So it's more of a stepping down approach that seems very likely right now based on the inflation data and their outlook on the economy. Jerome Powell emphasized that it's important that we continue to see a trend of inflation reaching down to that 2% target. You're going to read articles, you're going to see headlines talking about radically different inflation numbers. And as I mentioned before, it runs the gamut because the data isn't the same. It's not all created equally in the sense that they look at the change in prices differently in different metrics. The personal consumption expenditure is the Federal Reserve's preferred inflation gauge, but there's also the consumer price index, the CPI, PCE, CPI. You get very different numbers as we talked about last week. The Fed's most intently looking at the PCE. Even though we had some inflation data that we talked about on a previous episode last week, with inflation ticking up just slightly when we got the February survey for inflation, the trend is still downward. And that's what came through in the comments from Chairman Jerome Powell on Wednesday. The market response so far is kind of flat based upon all the information that was shared. The remarks from financial experts indicate that the perception of Powell's openness to rate cuts is laying a fruitful environment and optimism in the markets that things will get better from the standpoint of how much lending is going to cost and where inflation will possibly be going. As Chairman Jerome Powell was fairly confident that he is a cautious optimism that we can see a soft landing meaning that inflation will come down without significant harm to labor, unemployment, and consumer prices. Remains to be seen. We need to hit the 2% target in order for us to see that. But to know that there's that optimism based upon the Fed's current outlook is comforting. We're going to see how things play out over the next couple months. Like I mentioned on Friday, this gap period we have between meetings will leave the market up to operate on its own. And if the Fed does make any public comments, that is surely going to impact the market. But now we've got about 60 days for the market to digest all of this. And we're going to see how that plays out. We talked about at the top of the show, the 10-year bond is still in that 4.2 range and above. If we see that come down, that's when we're going to start seeing some meaningful change to the interest rates and a little bit more affordability for prospective home buyers. The anticipation of the rate cuts, despite the recent inflation data, has helped to bolster the confidence, particularly with the continuity of having those 3 rate cuts projected by the Fed. So that's all good news for us right now. In my opinion, this is about as good as it was going to get for Wednesday's announcement and Chairman Jerome Powell's management of the questions asked post-meeting and after his prepared statement. Since the Fed started raising the rates in March of 2022, there's been a notable impact, as we talk about weekly at this point, with how much more expensive it is to obtain financing for homes, for car loans, for credit cards, for personal loans. All of these things are heavily impacted by this rate rising campaign that started in March of 2022. We're looking forward to seeing things cool off when the Fed does cut the rates, but this is a tenuous situation. As I mentioned before, the economy is still very strong and resilient. If the Fed cuts the Fed fund rate, the discount rate, it's going to stimulate the economy, which has the propensity to have inflation come up again a little bit. So they're threading the needle right now, but they seem to be doing an okay job, if not good job, thus far, in my opinion, with managing the whole situation with all these complexities that are involved. The outlook right now is a cautious optimism that a soft landing is possible. However, we have to see the data. Chairman Jerome Powell mentioned it many times in his prepared statement, as well as answering questions from reporters, that they need to see the trend continue downward before they cut rates. The implication also was that if there's enough progress getting to 2%, the Fed is prepared to proactively cut the Fed fund rate. This would mean that if inflation is on its way to 2%, as I mentioned before, I like that term, striking distance, almost there. If the Fed sees that the PCE and that inflation indicator is getting closer and closer over a couple months to the 2% target that they have established, they will cut rates before it hits 2%. If they cut rates when it hits 2% without being proactive, you have a higher likelihood of throwing the economy into a recession, because at 2%, they're basing all this data, they're making their decision rather on all of this data, which, as we all know, lags. Some of the data is within 30 to 45 days. Some of the data is 60 days. If we're talking about real estate, someone buying a home now, just functionally, you're not closing for 30 days. So when we get the home sales data, it's a reflection of activity 30 to 60 days prior in the market. That's just one example. That kind of permeates every industry in some capacity, that there's some sort of a lag. So that's why they're going to be proactive, which is good news for us, as we're hearing from Federal Chairman Jerome Powell. That's it for me today. Just a quick little update. I'm looking forward to giving you a thorough real estate update this coming Friday. I should have the National Association of Realtors existing home sales data available to me. So we'll do that deep dive like we do on a monthly basis to go over what February looked like. If you have any questions or anything you'd like highlighted on the show, please feel free to reach out to me, call, text, hit me up on socials, as well as share the show with anybody that could benefit from having this information on a regular basis. Looking forward to catching up with you all on Friday. Between now and then, make it an awesome week and take good care.